Are you paying attention to the economic shifts that could redefine your investment strategy?
In this video, financial experts like Danielle DiMartino Booth bring you invaluable insights.
With our AI-powered summaries, we've condensed hours of analysis to help you grasp essential market trends effortlessly.
So let's dive in. First, hear from Danielle about the pressing inflation issues facing us today.
Welcome to the 2025 annual edition of Roundtable Prime, featuring insights from Danielle DiMartino Booth, the founder and CEO of QI Research.
Danielle brings a wealth of experience from her time as a Fed insider, enabling her to analyze current economic dynamics with a unique perspective.
Danielle points out that inflation has presented significant challenges as economies recover from the pandemic.
She emphasizes how the Fed's response to inflation will critically shape economic policies moving forward.
What are Danielle's insights regarding the Fed's current challenges?
Danielle asserts that the Fed is balancing inflation control with unemployment fears, complicating their policy decisions.
Can you summarize Danielle's view on the long-term inflation outlook?
Danielle believes inflation is structurally higher, hovering around 3 to 4%, which necessitates adjustments in monetary policy.
What does Danielle say about the relationship between wages and inflation?
She highlights that rising labor costs are exerting upward pressure on consumer prices, posing challenges to economic recovery.
What predictions does Danielle make about inflation for the next few years?
Danielle predicts that inflationary pressures will persist into 2025, with potential spikes related to geopolitical events impacting supply chains.
What does Danielle foresee regarding the Fed's policy actions?
Danielle anticipates a gradual tightening of monetary policy will be necessary to combat the higher inflation rates.
What should investors keep in mind based on Danielle's analysis?
Danielle advises that investors remain cautious as inflation rates fluctuate and market responses to Fed policies may lead to volatility.
And how important is it for investors to keep an eye on global events?
She emphasizes that geopolitical events will significantly influence market trends and investor sentiment moving forward.
Today, we're breaking down a chilling analysis by Nick Gurley regarding the housing market trends in 2025.
Nick dives into the data from the Wall Street Journal that shows home sales at their lowest level in 30 years. As the host of Reventure Consulting, Nick brings to light the alarming shifts in home buyer demographics and market behavior.
Nick emphasizes that home sales have plunged 34% from the peak levels achieved during the pandemic.
That's on par with the collapse seen during the 2008 financial crisis, signaling severe buyer demand issues.
According to Nick, the current levels of buyer demand are eerily reminiscent of the market conditions leading up to the last crash. Nick points out an alarming trend. The median age of homebuyers has risen to 56, indicating a demographic shift.
This trend suggests that younger and first-time buyers are increasingly sidelined.
Nick highlights that first-time homebuyers now make up only 24% of the market.
This marks a significant drop from 33% before the pandemic, showcasing a worrying market shift.
Another point Nick raises is the surge of high-end home sales, which is artificially inflating the average sale prices.
This means that while high-end prices rise, lower-end homes struggle to attract buyers.
What does Nick predict for home prices in light of these trends?
Nick forecasts continued downward pressure on prices as low demand persists throughout 2025.
Are there specific areas where inventory might spike and change the game?
Yes, Nick notes that if inventory levels rise significantly in lower-priced markets, we could see prices start to decline.
Nick underscores the importance of looking closely at local market data rather than relying on national averages. Finally, Nick advises potential buyers to stay informed on evolving trends to make the best decisions in their specific markets. Today, we're delving into an insightful analysis from Keith McCullough, the CEO of Hedgeye, as discussed with David Lin.
Keith brings a wealth of experience in market analysis and predictions.
Keith McCullough explains how the rise of China's DeepSeek AI is a significant threat to NVIDIA.
He suggests this competition is affecting investor sentiment dramatically.
Keith notes that not only is NVIDIA facing competition from DeepSeek, but their own growth is slowing.
This combination is worrisome for investors.
What can you tell us about NVIDIA's stock performance, Keith?
NVIDIA's shares dropped by 16% in response to the news about DeepSeek's resilience.
That's a hefty drop. What's driving that?
The market views DeepSeek as a real threat, marking a pivotal moment for NVIDIA.
What does Keith predict about U.S. tech investments?
He anticipates a possible rotation of capital from American tech stocks to emerging competitive resilience, suggesting.
And how does volatility play into this?
Keith suggests we may see more volatility as competition intensifies.
What's the broader economic context, Keith?
Despite the downward trend in some tech stocks, the overall market shows resilience, suggesting a shift in what sectors attract investment.
What's your outlook for tech stocks moving forward?
Keith suggests that unless NVIDIA can rebound, we may see sustained pressure on tech valuations.
What about AI technologies, Keith?
AI tech is likely to gain more attention in the investment community, potentially reshaping sectors.
Keith recommends keeping a close watch on AI companies, especially those challenging established players.
It's crucial to analyze their growth trends.
Keith suggests diversifying investments to buffer against volatility in the tech sector.
This can include looking into healthcare and other robust areas.
Today, we're examining George Gammon's analysis on the explosive emergence of DeepSeek and its potential impact on the stock market.
George's insights delve into how DeepSeek could represent a shifting paradigm for tech stocks and investors.
In his video, George discusses how the rise of AI tools could disrupt the market landscape.
He emphasizes that these changes could ripple through the global economy, affecting investors across the board.
George highlights how DeepSeek has put immense pressure on established companies like NVIDIA, effectively reshaping the tech landscape.
He notes that NVIDIA experienced the largest market cap loss in history, losing over $600 billion in a single day.
George warns about systemic risk, likening the market to a Jenga puzzle, where one disruption could lead to widespread instability.
He notes that the over-reliance on a few tech stocks has made the market exceptionally fragile.
What does George imply about the broader market when NVIDIA faces such catastrophic losses?
According to George, such losses signal a potential downturn across tech stocks and could herald more significant market corrections.
George notes how DeepSeek's efficiencies in AI could disrupt energy consumption forecasts, impacting related sectors.
He explains that if technology relies less on energy, this could reset valuations across the tech landscape.
George questions if DeepSeek could be the next black swan event in the markets, signaling unexpected shifts.
He warns that ignoring these developments could leave investors vulnerable to unforeseen downturns.
What does George predict regarding the overall market corrections following the DeepSeek news?
George suggests that the market could drop by 20 to 25% based on historical trends after similar shocks.
How does George foresee investor behavior change towards tech stocks?
He anticipates heightened caution as investors reassess company valuations amidst changing tech fundamentals.
George emphasizes that investors must remain vigilant in monitoring the evolving landscape post-DeepSeek.
Staying aware of systemic risks and their potential implications is critical for managing investment portfolios.
What does George suggest regarding alternative investments?
He advises looking into treasury bonds, gold, or other assets as a hedge against market volatility.
Today, we're exploring insights from Jeff Snyder, a prominent economist and financial analyst whose perspectives shed light on the current state of the global economy.
Snyder provides a critical analysis of shipping data as it pertains to economic trends.
As the host of Eurodollar University, Jeff has a deep background in tracking financial indicators that foreshadow market trends.
His comments on consumer confidence and shipping rates offer valuable insights.
Jeff Snyder underscores that shipping rates for raw materials have collapsed, indicating a severe economic slowdown.
This decline in shipping rates is a leading indicator suggesting further economic challenges ahead.
He notes that consumer confidence has plunged in January, reinforcing concerns about job security and economic well-being.
This shift reflects a broader anxiety among consumers related to incomes and employment prospects.
What does Jeff say about the relationship between shipping rates and other financial indicators?
He highlights a strong correlation between the Baltic Dry Index and economic indicators like Treasury yields and swap spreads.
How does Snyder link consumer sentiment to the broader economic picture?
Jeff explains that consumer confidence is closely connected to perceived economic conditions, which are currently deteriorating.
What implications does this have for interest rates, according to Jeff?
He suggests that as demand falls, we may see nominal interest rates adjusted downward globally.
What does Jeff predict about demand trends moving forward?
He foresees continued weakening in demand based on current shipping data and economic indicators.
What might this mean for monetary policy?
According to Snyder, we could expect interest rate cuts as central banks react to a declining economic landscape.
Jeff Snyder emphasizes the importance of tracking shipping rates as they provide crucial insights into economic trends.
These indicators can serve as early warnings for broader economic conditions.
It's equally vital to stay alert to shifts in consumer sentiment, which can directly influence market dynamics.
Understanding these trends can aid in making informed financial decisions amid uncertainty.
What a riveting discussion we've had today with these financial experts.
Absolutely. Each guest brought a unique perspective on the challenges our economy is facing.
One major agreement among them is the recognition that liquidity issues and overleverage pose serious threats.
Right, but there's some disagreement on how quickly we might see disruptions. Jeff Snyder believes we're on the edge of immediate issues,
while Keith McCullough takes a more measured look, predicting an economic downturn may take time to play out.
And let's not forget Nick Gurley's insights on the real estate market, which adds an interesting layer to the conversation.
True. He highlights how shifts in real estate could impact overall growth, which diverges from George Gammon's focus on the entire financial system.
These differing viewpoints encourage us to consider the economic landscape from all angles.
If you found these insights valuable, remember to give us a like and subscribe.
Your support means we can continue to bring you in-depth analyses from top financial experts.
Stay tuned for our next video, where we'll explore even more crucial insights that you won't want to miss.